Well, good evening. I'm Bob Glauber. I'm a member of the faculty here at the Kennedy School and of its Massafar Romney Center for Business and Government. It's a pleasure to welcome all of you to this year's lecture, which is funded by NASD, which is now FINRA, the private sector regulator of the U.S. brokerage industry. Focus of this series of lectures is on financial regulation. And each year, we have had a leading public official responsible in some way for U.S. financial regulation. This year, our speaker is a tiny bit of a stretch, but really not much at all. Ed Haldeman was CEO of Freddie Mac from mid-2009 to just a few months ago. While in that role, Ed was not formally a public regulator, he was responsible for running a very large public financial institution. Freddie Mac and its sibling Fannie Mae are what are called government-sponsored entities, GSEs, for years described as private companies with a public mission of supporting housing, or more simply, as mixed public-private enterprises. But in September 2008, both institutions failed financially and were placed in government conservatorship, becoming quite unmixed, just public corporations. The GSEs have had many problems prior to their conservatorship. Ed was not part of that, arriving about a year after conservatorship. But Ed was part of the solution. The task of running Freddie Mac is a big challenge. It's a very large business with about 5,000 people and with a balance sheet at its peak before conservatorship of just under $1 trillion. That included about $800 billion of mortgages financed directly by Freddie and another $1.7 trillion of mortgages guaranteed but off balance sheet. Together with Fannie Mae, Freddie was responsible for roughly half of the U.S. mortgages made to homeowners. Since conservatorship, the amount of mortgages directly on the balance sheets of Freddie and Fannie have declined, but their role in financing U.S. home ownership has in fact shot up. Today, roughly 3/4 of U.S. mortgages are made or guaranteed by Freddie and Fannie. I had a bit of a role in attracting Ed to run Freddie after it was placed in conservatorship. I was on the Freddie Mac board, head of its governance and nominating committee. The first CEO of Freddie, who was put in place by the Treasury Department at the time of conservatorship, quit after 6 months. We had to make a pitch to Ed to take the job. It was fairly simple, a most challenging job, which was a dramatic understatement, but the opportunity to do meaningful public service. Freddie and Fannie needed very strong leadership and steady guidance as they rehabilitated themselves and waited for the government to decide just what to do with them. I should point out that we're still waiting for the government to decide just what to do with them. It's now 4 years since conservatorship, and beyond some partisan back and forth about banks' handling of foreclosures, housing policy has been one of the elephants in the room during the campaign. Ed has had an outstanding career in both public and private sector, leading important financial institutions. After degrees from Dartmouth, HBS, and the Harvard Law School, Ed started his career with a Philadelphia investment counseling firm, Cook & Beeler. Cook & Beeler was later bought by a Boston financial firm called United Asset Management, which Ed eventually ran. From there, he went on to become chairman and CEO of Delaware Investments, a large mutual fund management company. And next, he was called in to run Putnam Investments here in Boston, an even larger mutual fund management firm that had experienced some regulatory failings by the previous management. He righted that ship and eventually sold Putnam at a very good price for its shareholders to a large Canadian financial firm. It was at that time that we approached Ed to run Freddie. Freddie and Fannie, together with the broader issues of U.S. government involvement in housing finance, is one of the major unfinished pieces of business in financial regulatory reform. It's clearly an important issue. We have C-SPAN here tonight filming this. Ed has a unique perspective on that issue, the perspective of an experienced manager on the front line running one of the GSEs and a most thoughtful public policy participant. This evening he's going to talk about where the GSEs have been and what to do with them. It's my great pleasure to introduce Ed Haldeman.
Bob, thanks so much for that kind introduction. I'm very appreciative of so many of you coming out tonight to visit with me and learn about Freddie Mac and the GSEs. I'm particularly pleased to be giving the Glauber lecture here tonight. There are many, many people, perhaps hundreds, maybe it would even number in the thousands, of people whose career was launched by Bob Glauber. I'm one of those. Bob Glauber taught me investment management in 1973 at Harvard Business School, and then, as he indicated, I spent approximately 35 years in the money management industry. So I don't distinguish myself based on my career being launched by Bob Glauber, but what I think is a little bit special about me, perhaps unique, is that my career began and ended with Bob Glauber. And since, particularly this week, I think I ought to be careful about the preposition I used in that last clause, because Bob was on the board, I was the CEO, and the preposition I used was my career ended with Bob, not by Bob. And I think this week particularly, I'm sensitive to making sure everybody knows that we ended our time at Freddie Mac together. I'm also pleased that the subject of the Glauber lecture tonight is Freddie Mac and the GSEs, so that I have an opportunity, now that I'm no longer the CEO of Freddie Mac, have an opportunity to present a balanced view of the GSEs. This is a subject, that is Freddie Mac, the GSEs, which I have come to see others speak very aggressively, emotionally. It's a subject that gets very heated, and it is very uncommon for people to present a balanced view. In fact, my goal tonight is to present a balanced view of the GSEs, and if I succeed, I think it may be the first time that there has ever been a balanced presentation about the GSEs. Certainly, the employees that worked with me were passionate about their role, the function that they performed. Almost a religious kind of mission is what they felt they were doing at Freddie Mac. And it was hard to imagine that there were other people in society that had the same kind of visceral feel in the opposite direction about the work that they did, and neither side able to see the other point of view. Hopefully, in the course of the next 15 minutes or so, you will come to a balanced opinion about Freddie Mac and the GSEs. I want to start with where they've been, and I'm going to go back quite a bit in time, back to 1938, when the first GSE was created, Fannie Mae, to think about what the mortgage market was like at that point in time, because I think by doing so, we'll see some of the advantages and good things that have been accomplished by Freddie, Fannie, and the GSEs. Before Fannie, the mortgage market was very different than it is today. The only thing that was available were very short-term mortgages, 5 or 10 years, variable kinds of rates. A down payment, 50% was the standard in those days. There was a bullet payment at the end of the term. You had to come up with the whole thing at the end of this short term. Very large variations regionally with regard to availability of mortgage money and rate. No standardization in terms of underwriting at all done very locally with very different standards. And the mortgage market was not at all connected to the capital market, and as a result, rates were quite high in those days. Subsequently, the mortgage market has changed radically, and I think in large part because of Freddie Fannie and the GSEs. Most importantly, the mortgage market got highly connected to the capital markets. The secondary mortgage function performed by the GSEs connected the mortgage market to large pools of assets, the capital markets, including not just in the US, but worldwide. There was standardization in underwriting that was required by the GSEs, virtually an elimination of the variability in rates and liquidity by region. There was a broadening out in the access to mortgage money in our country. Before, very limited in terms of very high income people, very limited in terms of ethnic background. The GSEs broadened that out substantially, and most importantly, made sure there was widespread availability of fixed rate 30-year mortgages. Think about what is so special about mortgages in our country. Today, for about a 3.5% interest rate, you can get 30-year money with no prepayment penalty, a pretty unusual economic opportunity. So those are the early years, the advantages that GSEs brought to the mortgage market. Let's now think about the years just before the financial crisis and think about where the GSEs have been in that period of time. And the reason that it's worthwhile taking a look at this time just before the financial crisis is that there are many people who have argued and written that the GSEs caused the financial crisis, were the cause of the Great Recession. And as Bob Glauber indicated, I was not at Freddie Mac until way after the financial crisis, so I don't really have a stake in this game. But this is a chart that I would look at to sort of determine to what extent I thought Freddie Mac, Fannie Mae caused the crisis. And again, I'm not saying that perhaps we'll find later some contribution, but do you think they caused it? And this chart looks at market shares. And the market share of the GSEs is at the top, and it's that blue line. And then the reddish line that starts at the bottom and gets very high in 05, 07 is the private market, the private secondary mortgage market. So this is the investment banks and the commercial banks issuing secondary MBS securities, private label securities we call them. And look at that radical market share change. Freddie and Fannie going from on the order of 75% down to 40%, falling like a rock. And the private label taking tremendous share. What would be the cause of that? Cause, in my view, is a change in underwriting standards. A change from requiring substantial documentation and high underwriting standards, large down payments. Many of the private capital competitors reduced some of those standards and were able to take substantial market share. Now imagine you are the CEO of Freddie Mac at the bottom market share number, 40%. You've seen your market share for the two GSEs go from 75% down to 40%. Do you react or not? Do you change your underwriting standards? How much can you tolerate in terms of market share loss? As the CEO of Freddie Mac, I had 5,000 or 6,000 employees. It looks like the entire market is going away from me. Do I change or not? And I think that the CEOs, the people running the company, did make some changes. And we each can make our judgment about what we would have done in that position. But I'd at least argue it's a hard call. It would not be easy to be unchanged in terms of your requirements on down payment, underwriting standards, and have that market share go completely away like that. This is another indication of, I believe, whether or not Freddie was the cause of the financial crisis. And here we take a look at mortgage default rates over time. The definition of default is 90 days delinquent. And you can see that at Freddie and Fannie, at the worst, our delinquency rate got up into the 4 to 5% zone. For the overall mortgage market in our country, it got to be 10%. And for the subprime sector of the market, it got up to be 25%. So again, while I believe that Freddie and Fannie did lower their standards, look at the resulting delinquency rates, and I think you can see a big difference between the way Freddie and Fannie behaved and the way the rest of the industry did. So where I've come out on this is that I don't believe that the two GSEs were the cause of the financial crisis. I do think they did reduce underwriting standards, but I think I can understand why as a CEO you might have done that given what the competition was doing. I do think there were some mistakes and problems made that were connected to the GSEs, and certainly one that I found troubling was summarized in a book by Gretchen Morgenson called Reckless Endangerment, which is a story of crony capitalism exhibited by the two GSEs. And I view that book almost as a playbook on how businesses can execute crony capitalism and get close to government for their benefit, not just an incredible lobbying organization, not just massive campaign contributions, but things like hiring repeatedly people coming out of government, opening regional offices in all of the critical congressional offices, and hiring relatives of congressmen in order to fill those regional offices. So to be sure, some of the criticism that Gretchen Morgenson offers is accurate. A second problem was the implied government guarantee. This was not something that necessarily was generated by the GSEs, but rather they took advantage of it. But what they were able to do because of the implied government guarantee was borrow essentially as much money as they wanted to at the government rate. So unlike most private companies, when you put on more and more debt, the rate goes up. They were able to borrow almost unlimited amounts at the government rate and then create a retained portfolio, which some people have described as a hedge fund because one was able to arbitrage the difference between the government rate and the rate that they used to buy, in some cases, private label securities. So I don't think the GSEs are without fault, but I do think it is a stretch to call them the cause of the financial crisis. So let's talk about what the GSEs have done subsequent to the crisis since they've been put into conservatorship. That's the point in time that I'm more familiar with. And one of the things that they have done, and one of the reasons I took the job, is that they have been the only game in town for the mortgage market. And here the numbers accounting for 75% of the total mortgage market. If you add in FHA, another government mortgage provider, you get to about 95%. So the private market has been providing only about 5% of the mortgage money. Where would we have been over the past 3 or 4 years without the GSEs performing this function? In addition, we worked with the administration and the Treasury Department in order to execute some of the government programs. HAMP and HARP are the names, Home Affordable modification program and home affordable refinance program. And you can see that the number of modifications done since conservatorship is 1.2 million homes, a big number. The only problem with that number is when the idea of modifications was first generated, the program was quickly taken over by political people in and close to the White House, and they decided that they needed to make an announcement of what HAMP was going to do, and they said it was going to do 3 or 4 million modifications. I have no idea how anybody got that number, but somebody wanted a big number, and as a result, 1.2 has always seemed like it wasn't very successful. It's a pretty big number, and the GSEs executed not just the modification program, but also the refinance program. One of the things we didn't do was we didn't do principal forgiveness. And that is I'm not quite ready for this one, but on this list of things up here, we didn't do principal forgiveness. And some of you have read criticism about us not doing principal forgiveness. We believe pretty strongly, as did our regulator, that there was a real risk of strategic defaults were we to offer a program of principal forgiveness, which is to say that even though Freddie has lots of underwater mortgages, over 80% of them are still current. Nobody's had any problem or has continued to make their obligation despite being underwater. We worried about the, principal forgiveness having some impact on those 80% of the underwater mortgages, and we thought it better to focus our attention on HAMP and HARP rather than add principal forgiveness. Wanted to spend just a minute on another part of our record subsequent to conservatorship, which would be profitability. Many of you have read about Freddie Mac, Fannie Mae being a black hole. The record in front of you shows two bars. One is the amount of draw that we have taken from the federal government, and the green bar is the amount of dividends paid. And what a lot of people don't recognize is that the dividends that we have to pay now are a number like $7.2 billion a year. So if you generated $7 billion in income, you'd still have to draw something from the government. And that's why people continue to talk about draws. If you look at that total record for the entire time of conservatorship, the round numbers are a draw from the government of $70 billion and dividends of $20 billion, meaning a net draw of $50. And you can see in 2008, when that year was done, the draw was $48 billion. So almost everything subsequent to 2008 has been a draw required to pay a dividend. That is a net neutral impact on the Treasury. And the reason we've been able to get to that level of profitability is that all the mortgages that have been put on in the past 4 years during conservatorship have been very high quality in terms of down payment and in terms of FICO score, much higher than was the case prior to conservatorship. And this new book, the stuff subsequent to conservatorship, now accounts for over 60% of the total book of Freddie Mac. So let's switch. So that was all past. We talked about the real old time period, 1938. We took a look at the pre-crisis period, and then we've looked at post-conservatorship. Let's now look forward and think about what to do with Freddie Mac going forward. It has been a great frustration to me that the Treasury Department and the administration has come up with no program, policy, or recommendations as to what to do. It is now 50 months that we've been into conservatorship. It is now 50 months that 6,000 people who work at Freddie Mac don't know if the company's going to exist. They have no job security at all. The Treasury was to put out a position paper in January 2010 with a suggested solution. They didn't do that. It didn't come until January 2011, and then the white paper listed just three options that would have been obvious to anyone on day one of conservatorship. So it's a great frustration that we've made no progress in this area, particularly when I believe there is strong consensus on what we ought to do. Before you is a proposal that was put forward in August of 2009 by the Mortgage Bankers Association, which talks about forming companies, private capital companies that they called McGs, mortgage credit guarantee entities, which would be 3 to 5 in number, that would be private capital companies that would compete with one another, that there would be no government guarantee of the companies. There would be a government guarantee of the securities, the mortgage-backed securities, but for that guarantee, the McGs would pay an insurance premium much like FDIC insurance. The securitization would only be of plain vanilla kind of mortgages. Anything exotic would have to be done in the private capital market, and there would be no retained portfolio at all. So we had this proposal, a sensible proposal in my view, in August of '09. 3 years later, a really smart guy named Jim Milstein, who was at the Treasury Department, he's the guy who's responsible for the restructuring of AIG. He is a lawyer and investment banking restructuring kind of person, and he put out a proposal which has many common ingredients that we saw from the Mortgage Bankers Association. Here the emphasis is on a government agency, the Federal Mortgage Insurance Corporation, which authorizes, manages, regulates a series of securitizers who issue mortgage-backed securities. And again, the companies are not guaranteed, just the securities are. And the beauty of both of these proposals is that the technology and the infrastructure and the systems and the human capital of the GSEs would not be wasted, but could form the basis of one of these securitizers that would compete in the private capital market going forward. So I believe that there has been some consensus around a proposal that is feasible, would work. One was issued by somebody who had an axe to grind, that is the Mortgage Bankers Association, but Milstein, coming from the Treasury Department, presumably his view is what's best for the economy, but it's a very similar kind of proposal in my estimation, and I wish that we could move ahead with something like this, and it would be a tremendous benefit, I think, for the taxpayers to get some usefulness out of this investment that they have made in the GSEs and keeping them together and functioning, to use the skeleton, to use the infrastructure in a way that allows the taxpayer to get a benefit, to get some monetization of the investment that has been made over time. So in summary, on this, where should we go? I think the most important thing is to go somewhere soon. It is incredibly challenging to work at Freddie Mac and Fannie Mae, to have this uncertainty, to not know whether you have a future. It is debilitating. Over time, these entities are becoming less corporate-like and more government-like, and from my point of view, that's regrettable. So I hope I've given you some insight into where we've been with the GSEs, where I think we ought to go, and I'd be interested in your questions. Bob?
Great. Thank you, Ed. Let me just remind all of you of the ground rules. We ask you to identify yourself, and we ask you to do something very simple, to ask a question rather than make a speech, and that the question be reasonably contained. I'm going to ask the first question. You've said where you'd like to go. You said, Ed, you're concerned that nobody's going there yet. Have any forecast of just when you think Congress is going to go somewhere and what the process will look like?
Yeah, I made my decision to leave Freddie Mac because I thought it was going to take a long time before we would get resolution, unfortunately. I joined the company middle of 2009, and at that point, everyone was essentially certain that the company would be relaunched in some form in a couple of years. And obviously, we've been disappointed in that. And as the calendar rolled through 3 or 4 years, I concluded, looking at my birth certificate, that I probably wasn't going to make it. And that was one indication of my pessimism about when we were going to get this resolved. Clearly, it was clear to all of us that as we got into the election year that nobody was going to spend any time on it, and it's been remarkable how silent the two candidates have been on this subject, given how much is at stake. And I think once we get the election over and get the new Congress established, they've got an agenda with more significant things like tax policy and like policy on the deficits. So I think there's going to be, we're going to have to wait a good long period longer before we get any kind of action on this. And then there's the implementation delay. I'm just talking about when somebody puts out an idea, which has to be challenged and fought with in Congress and debated, and then you get something passed, and then you've got your implementation. After all, think about where we are in terms of implementation on Dodd-Frank, where we are in implementation in terms of Obamacare. I'm unfortunately very pessimistic about when we finally get resolution.
Okay, let's start with the questions. Yes, sir.
Hi, I'm Ryan Kennedy. I'm a student at Harvard Business School and Harvard Kennedy School. You started your remarks talking about the incredible political influence that Fannie Mae and Freddie Mac had before their conservatorship. As we think about the entities that will follow, how do we think about creating the appropriate amount of political insulation against lobbying when it comes to things like capital requirements or appropriately pricing the government's guarantee?
Yeah, that's a real struggle. I could tell you that during my time, during the conservatorship, we had really strong restrictions on us. We were not able to make any political contributions, not just at the corporate level. I personally was not able to do it. I happened to go to law school with a couple sitting senators. I wasn't able to visit with them even in a personal sense. So it was precluded from any interaction with any member of Congress whatsoever. If I was going to go to the Hill, had to go with our regulator. Before I got there, when we were placed in the conservatorship initially, all the lobbying was stopped and the lobbying people were let go. So during this period of time, you should know that I can tell you that it has been totally insulated with a couple exceptions which were really annoying to me, which were Congress, a member of Congress, who felt like they owned Freddie Mac, like they owned me, would call on my personal cell phone, I don't know how they got it, trying to make me intercede on some action that the company was about to take in her district, presumably some kind of a foreclosure kind of activity that had gone through the process. I was asked to intercede. So there was an attempt in that direction, and all of that makes me a little bit pessimistic about your question. I think when we get to the resolution, one would hope that we would have these private capital companies which would be regulated very closely with restrictions on campaign contributions, lobbying, that kind of thing. But we're also going to have strong leadership at those things who don't buckle to the pressures that they receive. But it is a problem, and I guess the reason that I'm not too pessimistic is because we have gone through this period of time where the two GSEs have been incredibly disciplined about avoiding involvement in political activity.
You also talked about the discipline of the GSEs during this period and the quality of the mortgages that they have guaranteed. Have you come under any pressure to ease that stringency during this period?
Very, very modest. And there would obviously be statements made by members of the Treasury Department administration suggesting that we were too tight, or the other place that we would get a little bit of pressure is how aggressively we took the putbacks to financial institutions. But very, very modest, I'd say, and reasonable, not particularly troubling.
Please.
Hi, I'm Amanda Benton. I'm a student here at the Kennedy School. I really liked your charts, and everything was very helpful. It looked like they focused primarily on the single-family side of things. I'm interested to hear what you think about sort of the status and outlook for the multifamily portfolio.
Good. Thank you for that. I'm going to grab a sip of water. This is the second time I've spoken since the vice presidential debate, and as a result, every time I sip some water, I wonder whether it's too much or too little, or whether it's appropriate or not. So multifamily is a real great story at Freddie Mac. It turns out it's about 10% of our business, but it's a very, very successful business, and it's one where we have had, I showed you the chart on the single-family delinquencies, and we're real low relative to the industry overall, half as much, no matter what time period you look at. The multifamily business had an infinitesimal default rate consistently throughout the whole thing, maintained high profitability throughout, such that many people, industry kinds of people, have been anxious for that business to be spun out individually as a standalone kind of business, and that is something that is feasible and another way that taxpayers could receive money. But I'm really proud of the effort that we had in multifamily at Freddie Mac. It's a great team, and I think could be a very, very successful standalone company going forward.
Please.
Hello, I'm asking this question on behalf of the JFK Junior Forum Committee. In the current revision of the Freddie Mae and Fannie Mac bailouts, would you say that those companies have lost the ability to recapitalize themselves?
I think in the traditional way of using the word recapitalize themselves, yes, because of the 10% dividend requirement. So when most TARP institutions got money, to use your word, a bailout, there was a 5% dividend with an ability to repay that. At Freddie and Fannie, the dividend was 10% with no ability to repay. So as a result of that, the ability to recapitalize themselves, to use your phrase, really isn't there. And I mean, the numbers for Freddie Mac are that the total draw in round numbers is like $72 billion, meaning that the dividend payment annually is 7.2. So really, really hard to generate enough capital to meet that dividend and then accumulate on your balance sheet so that you would have a chance of recapitalization.
Yes, sir.
Hi, I'm Sumit Malik. I'm a senior at the college. Thanks so much for taking the time. You began your talk by discussing some of the important advances in the mortgage market after the introduction of GSEs. And I wanted to know, in your opinion, in the modern society and looking forward, to what extent do you think a more purely private sector driven solution is able to, or would be able to, achieve the public goals of the GSEs?
Yeah, so let's hypothesize no government involvement. You'll remember that the suggestion that I made had what I think is limited government involvement, right? Say 5 private capital companies, none of which are too big to fail, none of whom have a government guarantee, but the securities, the mortgage-backed securities that they issue would be government guaranteed, and there would be an insurance premium paid for that guarantee. So that's the extent of the government. Let's hypothesize now, to go to your question, that there is no ultimate reinsurance, ultimate government backstop of the securities. The disadvantages to that, I think, are largely in the cost of mortgages. And I believe that the mortgage rates would be materially higher as compared to my suggestion. And the reason is that I think there are big sources of capital worldwide that will only invest in our housing mortgage market if there is some kind of ultimate government backstop. I think there are big pools of assets in Asia, for example, that will only invest if there is an ultimate government backstop. I visited during my tenure with some of the holders of Freddie Mac securities from foreign institutions, and they said they would not buy anymore, and were reducing their holdings because even under the current state of affairs, they weren't exactly comfortable with the ultimate government guarantee, and they made it clear that how significant it was to have that guarantee if they were going to invest big pools of assets in our housing market. So for that reason, I'm willing to tolerate that limited amount of government involvement.
Thank you.
Ed, you just said that without government involvement, there would be a higher price for mortgages. And I'll bet that's right. I think everybody would agree that the consequence of just letting the private market do this would be higher mortgage costs. What would be the consequences of that, and would those consequences be good, bad, or not matter?
The consequences of the higher rates? Yeah. Well, I think they would be significant. I think that already we are going to narrow down the universe of possible home buyers because the down payments are so large. And then if you compound that with a higher interest rate, we're just going to narrow that potential universe of home buyer down to a level which I think is unacceptable in American society. And we definitely went too far towards the goal of making everybody a homeowner. We had that single-minded objective of getting that percentage higher and higher, and I think we pushed too hard. But I think that if you compound a 20% down payment with significantly higher mortgage rates, I think we would be narrowing the universe of home buyers into too small a group.
Thank you. Yes, sir.
Hi, my name is Jacob Morello, and I'm a sophomore here at the college. I'm wondering if you could talk a little bit about the climate and culture that you experienced when you assumed leadership in 2009, considering all that had transpired in the months before. Kind of what were the expectations and pressures that you faced?
Yeah. Try and describe it a little bit. So there are 5,000 or 6,000 people that work at this company. Many of them, like people employed anywhere in our society, had invested a lot of their money in the company. Their 401k had stock holdings. Many people are proud of the company they work for, and so they buy stock in their company. And their holdings went to zero. So, not saying everybody had 100% of their 401k in Freddie Mac stock, but there were big holdings that went to zero. And then the people were criticized by politicians and the press as being the cause of the financial crisis. These are people who literally believed that they were doing great work helping people. And somebody accuses them of the financial crisis. Many of the employees told me that when they would wear a Freddie Mac t-shirt or sweatshirt to the supermarket or the Home Depot, they would be accosted by people for what they had done. As Bob indicated, they were put in a conservatorship, and 6 months after the CEO arrived in conservatorship, he left. 2 months after he left, the person who was the chief financial officer, age 42, took his own life. He didn't do anything, there was no fraudulent activity, but because of the stress. So the employees had that list of thoughts and pressures with no job security, no idea whether the company was going to exist. Remember that there were senior politicians who repeatedly told the press that Freddie Mac should be abolished. In the white paper that the Treasury put out, they said many, many, many times that the company should be wound down. And those were what the friends of the GSEs said. Imagine the morale of the people. Because of that, I tried to spend as much time as I could being visible and talking to them and trying to come up with hope for the future, which was around this notion of us getting ready for relaunching the company in some form. And the good news is that the people hung in there and they continue to work hard, and the company is functioning quite well.
Yeah, hi. My name's Josh. I'm a student here at the Kennedy School, and I wanted to ask you for your perspective on, or your reaction to the perspective of Raghu Rajan in his book Fault Lines, when he, amongst other things, he calls for a need for cycle-proof regulation, when he observes that we come up with these great ideas like you articulated and outlined very well. We come up with those at this time in the cycle, but then in better times they get dismembered and political pressure is applied to them under what he calls credit populism. And so he kind of says that we need to figure out ways to build regulation that somehow that won't happen to. They're immune to those pressures. Any thoughts on how we can do that?
No, it's a great thought, and I'll be only partially facetious when I say one of the best ways I know to prevent the problem you're talking about is to make sure that there are people around who have lived through many, many cycles, who have seen the movie before. And I know that's true in the investment business, where I spent most of my time, that the enthusiasm builds and builds and builds, and people become more and more aggressive as things go up and up and up, and they inevitably reverse themselves. And it seems like a new generation needs to go through that before they believe it. So I think experience and people, having people on staffs, regulatory authorities, or at companies who have gone through a few cycles is one great thing to have there. And then I think trying to insulate regulators from the political process is really an important thing to do, and we certainly didn't get that right at the GSEs. And if you haven't read Reckless Endangerment, you really should do it, because you can see how there was an attempt made to take the teeth out of the regulator, because if they got too aggressive, could just call people on the Hill and they would intervene. So those are two thoughts I have on how you might be able to accomplish that goal.
Thank you.
We've got to end at 7, so let me take one last question. Scott.
Scott Leland. I'm a staff member at the Center for Business and Government here at the Kennedy School. First, thank you very much for your talk. A question on the campaign. You said that there's a proposal from the Treasury in terms of what to do next with the GSEs, and presumably an Obama administration would follow something along those lines after dealing with the fiscal cliff and tax reform and all the other issues that are on the agenda. What about a Romney administration? What sorts of proposals, if any, have been articulated?
Yeah, so Scott, let me make it clear that I did not say that there had been a proposal by the administration. They produced a long-awaited white paper in January 2011, which laid out 3 options. Those options were a private solution, a government solution, or a hybrid solution. I'm not being very facetious here in saying that. So we haven't had a proposal from either side. Historically, I would expect that a Democratic administration would see some of the good things that the GSEs have provided. They'd go back to my opening charts about how the mortgage market has changed because of that, and want to keep something like them around. And I think that the Republican administration, if it came in, would want to go more to a free market kind of solution without any GSEs. I would hope that the suggestion I made and the Mortgage Bankers Association made and Jim Milstein made would be seen as something that both sides could live with, in that it is largely a private capital solution. There isn't a Freddie, there isn't a Fannie, there isn't this hybrid. There are 5 private capital companies that are competing who have the ability to pay a premium in order to get a government guarantee of their underlying securities. I would hope that that would seem enough of a free market solution that the Republicans would be okay with it, and enough of a protection of the housing market that the Democratic folks might find it acceptable. Okay? Thanks. Thank you.